And again, motivation and distress exists on a spectrum. It's not binary. As an owner, you're not either distressed or not. It's to what extent are you distressed? How distressed are you? How motivated are you? It all exists on a continuum. And at different points in time, people exist at a different position on that continuum.
Welcome to the Multifamily Wealth Podcast. I'm your host, Axel Ragnarsson, and on this show, I dissect how seasoned multifamily investors started, built, and scaled their businesses.
What's going on, everybody? Welcome back to another quick solo episode here on the Multifamily Wealth Podcast. In this episode, I'm going to be talking about distress, multifamily specific distress as it relates to why people sell properties, and more specifically, why owners sell properties for less than what it would be worth if they just took it out to the open market and effectively marketed it and secured the highest price. Why don't sellers do that every single time? Well, there's a whole slew of reasons why. And in my opinion, I think that there are three primary types of owner distress, and I'm going to cover those in this episode. And the reason that I want to do this episode is one, because I think it's helpful for folks that are going and actually offering on deals as it relates to thinking about the different types of distress and trying to identify whether or not the seller is experiencing any types of them. Because it may affect the price you offer, it may affect your ability to negotiate, it may affect how you actually approach that deal. Fundamentally, just being aware of the different signifiers of distress. Now, there's also a lot of talk about distress as it relates to multifamily right now, because everybody who bought with floating rate debt in these high supply growth areas are just getting hammered, right? In the Phoenixes and the Austins and the Tampas, et cetera, et cetera, et cetera. That's not indicative of the nationwide multifamily market, though, really at all. For example, New Hampshire, one of the markets that we invest in, average rents went up 11% in 2023, where average rents were falling in a lot of the markets that I just discussed, where there's been all kinds of additional supply being added to that through new development. So I think that people just assume that distress means one type of distress. It's a seller who's got an impending foreclosure, and they got to get out of the deal. They can't, they got to sell it. They can't make their debt payment. They have to do a refinance, and it's going to have to be a cash-in refinance because they don't have enough equity to refinance. And I think oftentimes people's brain, when thinking about distress, immediately starts thinking about debt. Like that's what they start thinking about is debt distress, debt-related distress, because that's typically the most prevalent kind. But that's not really that true. I think in multifamily, oftentimes distress comes in other forms, which is what I'm going to talk about in this specific episode. So let's talk about the three types of distress, which I personally define, and I haven't seen other people talk about this, but this is how I define it. In our business, we have ownership distress, we have debt distress, and we have operational distress. And an owner may be experiencing one or multiple different types of distress underneath each of those umbrellas at any given point in time during their life cycle of ownership. So let's start with ownership distress, because that's the first one I mentioned. I'm going to talk about some sub bullet points here in terms of what actually signifies ownership distress, as well as debt and operation when I get to those. But that can come in many different forms. Death of the owner and the passing of that property down to heirs, right? That's ownership distress as it relates to the ownership of the property, unrelated to the debt that's on the property, unrelated to how the property is performing. It's distress as it relates to the ownership. Partnership challenges. Couple of partners that want to go in different directions with a deal. Maybe one wants to hold long-term, one doesn't. One wants to sell and retire. Now we have partnership distress, and usually partnership distress is resolved by just selling the property. Retirement. Somebody's looking to, maybe you have an owner that's self-managing, they're getting up in their 70s, they want to retire and move to Florida. That said, they don't have operational distress, they don't have debt distress, but they want to get out of that deal, and they're maybe a little bit more motivated as a result. Change in the investing focus of the ownership group. For example, you have individuals that bought a lot of property in a certain geographical area, but now they want to go invest elsewhere, or change in what their focus is within that geography. We're buying a property right now from somebody who used to buy multifamily, but now they want to buy commercial assets. They want to go buy retail and strip malls. Change in focus. Does that signify a massive amount of distress? Maybe, maybe not, right? It really depends on the situation. For example, death and then the passing of a property to heirs That's a pretty a serious sign of distress, because it's really hard to just take over ownership of a multifamily property and continue operating it well if you're not in that business, right? Partnership challenges, more significant. Retirement, maybe a little bit less. Change in investing focus, maybe a little bit less than that. But they're all signifiers of some kind of motivation. And again, motivation and distress exists on a spectrum. It's not binary. You're not, as an owner, you're not either distressed or not. It's to what extent are you distressed? How distressed are you? How motivated are you? Right? It all exists on a continuum. And at different points in time, people exist at a different position on that continuum. Somebody that just had to, renovate a bunch of different units and they went way over budget is going to be more motivated to sell than somebody who didn't, who just bought the property, right? I mean, there's always a continuum here. But it's always helpful to keep your eye out for these different types of distress when you're speaking with sellers and when you're speaking with, maybe a broker about a given deal. So let's talk about debt distress, the second type of distress. All kinds of things come to mind here, and I think we're all pretty well aware of them. Upcoming balloon payment, the loan's coming due. Owners got to sell, refinance. They got to do something, right? Their balloon payment's coming due, their term's ending. Violation of loan covenants. Maybe there was some bad acting behind the scenes and they violated the loan covenants, and the lender is initiating some kind of foreclosure proceeding as it relates to that. Interest rate challenges. Maybe they have a high interest rate and they're trying to evaluate, do we refinance to get out of this high interest rate? Do we just sell and we'd rather just move on from this project? That can be a signifier of distress. Inability to refinance, right? Maybe the loan balance is too high on the asset as it sits right now. And this is a lot of people in the marketplace right now, and a lot of the markets I mentioned, they owe more than what they would be able to achieve as a new loan balance. So they got to go bring cash to get into that new loan, a cash in refinance. That's typically what people think about when they think about distress. They think about debt. That's typically where people's mind goes. And obviously these are signifiers of distress as well. Lastly, we have operational distress, which results from the operations of the property, the actual management of the property. Evictions, tenant challenges, right? Maybe the owner hired the wrong PM company and they're just not doing a good job of managing the property, right? They could have the right debt. They could not be motivated at the ownership level, right? There's no ownership distress, but there's some level of motivation, some level of distress based on who's actually managing the asset. Maybe they hired other bad vendors, a GC that stole from them, an attorney that gave them bad advice and botched, an eviction or something like that, or botched, a redevelopment presentation to the planning board or something like that. And then they're back at square one. Who knows, right? All kinds of vendors can screw up things along the way. Maybe they overpaid for construction, overspent on their business plan, and ran out of money. That kind of gets you into two things. That's a little bit of ownership distress, but that's primarily operational. Maybe they just bought in the wrong area and they aren't equipped to manage a C-class asset because they're primarily A and B class owners, and they just thought that this neighborhood they bought in was better than they thought it was, and their underwriting is misaligned with how the property is actually performing. Again, operational distress. So you can have any different types of these distress, whether it's operational, debt, or ownership, at different points in time during the ownership life cycle of an asset. And as a buyer, if you're an active multifamily buyer, you should be out there trying to spot any different numbers, any variation of these, right? If an owner has one type of distress, okay, that's a good sign. If they have two, there's probably a higher level of motivation. And if they have all three, and I'll share some examples, okay, well then this is most likely to be a very motivated seller, right? An example of all three. Let's say that an owner is looking to retire. They're getting older. Maybe they self-manage, right? They're in their 70s. I'm just assigning an age to it. So yeah, there's some retirement distress. That doesn't mean in a standalone situation that they would be a motivated seller, but okay, that's a signifier. Maybe they have a balloon payment coming due in the next 12 to 18 months, and they know they're going to have to do something in the short term with the property, whether it's selling it or whether it's refinancing it. All right, so now we've stacked another one on top of it. There's probably going to be some more urgency. Maybe they're also dealing with tenant challenges. They're getting older. They're getting a little bit more lazy with the management. They placed, two tenants in the building in the last few months that neither of them are paying. And now they're working through an expensive and frustrating eviction process with those couple of tenants. So you have somebody who's looking to retire. They're being forced to deal with tenant challenges, and they also have an upcoming balloon payment. That's probably going to be a motivated seller, right? You can probably craft an offer to solve those issues And it's increased likelihood that you can secure a quality price relative to what the market might pay for that in a non-distressed situation. And oftentimes a lot of these things stack, right? Let's say you have two partners bought a property, they overpaid for construction, they ran out of money, right? They thought they were going to have to both invest X amount of dollars and they ran out of funds. You have one partner that's looking to invest and continue seeing the business plan through. You have another one who maybe can't contribute money, maybe they're out of money. And then maybe they took a high interest loan to do this, right? Well, now we've overpaid for construction. We have some operational distress. We have partnership challenges because there's a misalignment in how they want to handle this project. So we have some ownership distress. And we also have some interest rate challenges given the fact that they took a bridge loan or something like that. Now we have debt distress. This is probably a motivated seller. Let's remove the debt distress from the equation, right? Let's say they just, they took a fixed rate loan at a reasonable interest rate and they don't have debt distress. Well, they ran out of money and they have, in terms of what they originally invested, and then we have some partnership stress at that level as well. Well, it's going to be likely that the resolution here is either costly for them to figure out and frustrating for them to figure out. And usually when partnerships kind of go awry on a deal by deal basis, the easiest and least expensive way to handle it is to just sell the property and go your separate ways. So we got some distress there. There's some financial and operational distress as well. And again, we've now picked out a couple of different signifiers that there may be some motivation. So you could craft a bunch of different hypothetical scenarios here, but you're going to start to look at the business in a slightly different way when you bucket the distress in these different in these different pillars and these different umbrellas, and you start looking for signs of all of them within a deal. And a quick little tip here for the active investors who are speaking with brokers, and then the passive investors that are evaluating deals with sponsors. One of the most insightful questions and helpful questions that you can ask, whether this is a LP to a sponsor or whether this is a buyer to a broker, why is the owner selling? What are they going to do if they don't sell and they keep the property? Give me some more intel about the ownership story, right? We love stories. We're huge story guys in our business, right? We're always looking for the story that aligns with what we're trying to buy. And usually by asking that question, you're going to learn a lot more about the ownership situation. And even if, it's, for example, a broker and they're representing the owner, they're not trying to, flip over their cards. Oftentimes you'll be able to pick out little things here and there. Oh, one owner, they buy a lot of retail. This is a multifamily property. They want to sell it, right? In a vacuum, that doesn't mean that they're willing to fire sale it, but that's a little bit of a signifier. Okay, all right, so we have some motivation. They're not going to go redeploy in multifamily. They're trying to get out of this asset class. Some follow-up questions. Maybe you're learning that one of the partners is looking to retire. Next thing you know, you've accumulated some information that allows you to make a better judgment call based on what you're offering and actually allows you to make a smarter decision on the buy side as it relates to the offer that you start with and that you negotiate to. So again, fundamental thesis of this episode, fundamental message I want to get across, start thinking about deal making as it relates to distress, motivation, where people fall on the spectrum of this, on the continuum of not motivated whatsoever to highly motivated. Start trying to put people on that spectrum and trying to analyze deals through that lens. It's going to help you negotiate better. It's going to help you screen deals a lot more effectively. And if you took something away from this episode, please consider leaving the podcast a rating and review. Coming up on 275, which is a massive milestone. So again, it takes 2 seconds if you're on iTunes. Scroll to the bottom, 5 stars. I will forever be indebted to you, and I will always be grateful that you did so. So please do so if you haven't already and you've learned anything here on the podcast. But again, I appreciate you all for listening and tuning in, and I will catch you guys on the next episode.